close. It's been an interesting day. I mean, definitely what's happened to, let's say, sterling has been the kind of key market mover. Big step lower here at midday. If you look at the morning, we ticked up through R1, and indeed I'll draw another line here. That was yesterday's high, and ticked up new 10-month high 132.87, and then sort of sideways into the Bank of England event at midday, and bang, huge move to the downside. So big stride lower. This is sterling weakness driven by Mark Carney and the Bank of England. Firstly, that midday move was, of course, off the back of the vote count, where the Bank of England voted to keep rates unchanged. 6 members voted to keep rates at a record low, and 2 members voted to hike. Some in the markets were expecting a vote count of 5-3. They were expecting a guy called Haldane, one of the voters, to swing on to the hawkish side and vote for a hike. Definitely that wasn't the majority view, but there were some out there thinking that, and so therefore when the 6-2 count came in, this is dovish, sterling weakness as a result. I mean, some of that downside is definitely a function of the fact that we've had a huge amount of upside in recent months, of course. Last couple of months, huge move higher. Part of this big move higher has been, or part of it has been, Mark Carney being hawkish a few weeks back, starting to talk about the fact that we're approaching the time where we're going to need to hike rates. That's when inflation was really striding higher. Inflation in the UK hit 2.9%, and those rate hike expectations ramped up, pushing sterling higher. Some of this move is dollar weakness as well, though, it must be said. However, big move higher, of course, so it doesn't take much to just tip this thing back lower, and so that's what happened this afternoon. You know, slightly dovish 6-2 vote sent the ball rolling on the downside. If I zoom in a bit, let's go to a 5-minute chart. That then kind of downside continued then for the next hour or so, and that's as Mark Carney started talking in his press conference. And here's like the headlines from the media. You know, Carney sees UK economy at Brexit's mercy. Its forecast slashed. Just take that with a pinch of salt. That's the financial media sensationalizing what was a downgrade to GDP forecasts from the Bank of England. Of course, what's not being reported here is the fact they upgraded their inflation forecast. But Mark Carney did, and also Carney said it won't take much if growth does accelerate on the upside. It doesn't have to grow by much for us to have to start hiking. But then he started talking about Brexit, and he said ultimately that, you know, over the next 3 years we might have to hike rates. And so that turned out to be another bit more of a dovish tilt, certainly compared to what he was saying a few weeks back, and so sterling carried on devaluing. And then we've settled down here, just chopping around, let's just say the 131.50 area. But a decent move lower. What's helped on the way back up here was then the second kind of big event of the day, which was definitely a surprisingly weak economic data print from the US, where we got the ISM Non-Manufacturing data coming in at 53.9. We were expecting 57, and as you can see, this is the worst reading since, well, for a year. So, you know, definitely a surprisingly negative outcome, which then led to dollar weakness, of course. So back to the chart, and this has led to a tiny rebound here. You can see this at 3 o'clock, slight step back up. I just draw a line here. We kind of tested the Bank of England low, and then ticked up. We haven't reversed much though. I mean, if you're putting like a Fibonacci series on here, then, you know, in percentage terms, we have not really, you know, nowhere near even the 38.2 retracement point. So most of this sterling weakness still in the system as a result of the Bank of England. If you're checking out, let's say, euro dollar, obviously the euro hasn't been impacted like sterling has. There's no monetary policy angles here for the euro, and so you didn't get the weakness that we did on sterling at midday. And so you got the dollar weakness coming through at 3 o'clock, which has led to a punch higher, but we're still short of that high we had yesterday. Last night, big spike to the upside as this market makes further, 30-month highs and seemingly, perhaps inevitably tracking towards that 120 handle that we might see at some point this week, which is a highly significant price point. So that's what's going on in the FX space, but the two big events are called Bank of England and then the ISM Non-Manufacturing data. What else has been going on? Well, gold has ticked higher. That was at, well, firstly around the Bank of England event and then at 3 o'clock off the US data. So trying to get back up towards the high point we had yesterday. Just look on a slightly longer time frame. Then gold's had a decent run in recent weeks, but just that high from yesterday, and then you got the top from the day before up at 1280. So middle of the range for the last few days here for gold, having ticked higher off the Bank of England and the US data. Stocks have been flat. I mean, the S&P had a go at selling off. I don't know, it's like US equities just can't go down. Doesn't matter what happens. We had a tick lower here just before 3, and then the data came and it was a bit choppy, and then we made a new low off the bad news from the ISM Non-Manufacturing, but then it was recovered. Obviously you got the angle here on, well, more bad data from the US. Can the Fed hike again this year? That kind of thought process. If the Fed don't hike again, well, is that good news for equities? I mean, I don't know if that's the case anymore. I think bad news is bad news. I'm not sure equity market reactions are quite on that same page yet, but the S&P just edging a little bit lower again now, but generally quite flat, just chopping around the pivot all day. If you check out the DAX, then we know we've had a downward trend for the DAX in recent weeks. This morning we tested that low from Monday, and since then we've been very quiet, actually, just trapped between S1 and what was the opening level this morning at 12,172. So again, quite a very subdued, pretty dull session for European equities, actually. Oil then, well, we had that pop this morning, pop up through that top we had going into the close last night. And then it's just been messy, and $50 has been the barrier on the upside. We've had a couple of attempts at launching and attacking that, and both have failed. 50's R1 as well today, so it looks like we're just going to be capped just below 50. But another up day for crude, continuing its march, or well, I guess we were higher. Let me go back to a slightly longer time frame. We have been higher, of course, earlier on in the week, up at $50.43. So as it stands, maybe expect a little tester of the high of the week, either into the close tonight or maybe tomorrow. Let's see, especially if that euro dollar carries on weakening, or sorry, strengthening, so dollar weakening. T-notes, I don't know, T-notes reluctant to get going on the upside today. We had bad data, it had an excuse to push higher, but it actually hasn't. So if we look on a longer time period, we are up around the upper sort of part of the range we've seen in recent weeks, and so the high today was just short of that main level that we've got back on the 21st and the 24th of July. But a bit of reluctance, it seems, for T-notes to push higher. Maybe people starting to look ahead to Jackson Hole in 3 weeks, where maybe there's just a little bit of nervousness that Yellen might come out and continue to be hawkish. So maybe that's just capping the upside for T-note prices here. So yeah, that kind of rounds things up. It looks like this S&P wants to drift back to the test the low. We'll see over the next few minutes. But just looking ahead at tomorrow, certainly we've got a big number from the US tomorrow afternoon. The dominant scheduled news flow, at least, will definitely come in the shape of non-farm payrolls due at 1:30. We had a nice strong number last month. 222 was the June print, and we will see what happens. I've just been asked a question which I will clarify. I think Will mentioned it also in the briefing earlier in the week. What is Jackson Hole? We keep referring to it as if everyone should know what this is, but I apologize for that. Maybe you don't. Jackson Hole is a place in the US. It's in Wyoming. And if you're keen on skiing, then that's where you want to go. But of course, I'm not talking anything about skiing here. This also happens to be the venue for the most important gathering of US, well, not only US, let's change that. The most important gathering of global central bankers, as well as academics, as well as some on the fiscal side as well. But it's an annual conference. And the reason for the conference actually is about academics and monetary policy setters getting together and thinking about longer term monetary policy dynamics. It's actually about thinking, are the current systems functioning? What new academic kind of research is there that's maybe looking at changing things up? Do we need to evolve as central banks? It's like long-term stuff. However, in recent years, first Ben Bernanke, then Mario Draghi, then Janet Yellen have all used this Jackson Hole annual event to make very important, highly significant announcements about changes to their monetary policy trajectory. So that's why it's important, and it's traditionally been an occasion where these big central bank governors have made key statements. So we'll look out for that. It's at the end of August. But Draghi's expected to speak. Yellen will be speaking, and we're expecting some news flow. So let's see. But yeah, just to wrap, non-farm payrolls tomorrow. And so that will be the main focus, obviously coming at us at 1:30. That's it for today. Enjoy your evenings.